Friday, 24 July 2026. 3 Asia-Pacific AI stories before your first coffee. Global AI infrastructure debt is heading toward $570 billion by 2026, and a growing share of that borrowed capital now flows through Asia's data center corridors in Singapore, Johor, and Tokyo as bond markets turn increasingly cautious on hyperscaler paper. Southeast Asia and Japan are projected to hold roughly 40% of global data center capacity by 2030, financed largely on the same leveraged model that U.S. hyperscalers pioneered. Sovereign-linked lenders, including Temasek Seatown and Granite Asia, are stepping in to backstop regional builds, but that concentration creates its own exposure. Why it matters. Capital allocators financing Asia's data center boom need to watch the gap between spending and returns. Moody's analysis and a recent MIT study both flag that AI revenue has yet to justify the scale of borrowing underwriting these campuses. And if bond markets tighten further, refinancing costs will hit Asia's newest megaprojects first. Builders planning facilities in Johor, Batam, or outer Tokyo should stress test their capital stacks against a scenario where cheap debt dries up before tenants reach full utilization. The second-order effect worth tracking: sovereign-linked capital stepping into the gap gives governments implicit leverage over which projects proceed, potentially reshaping site selection and tenant mix across the region's fastest-growing AI corridors. So, global markets delivered a sharp correction on 23 July, punishing AI stocks not because usage is slowing, but because investors are demanding proof of returns after 2 years of record capital expenditure. The sell-off hit Asia hard, with semiconductor and cloud infrastructure names across Tokyo, Seoul, and Taipei seeing outsized drawdowns as the market repriced the gap between spending and revenue. Cumulative AI capex by the major hyperscalers has now passed $300 billion, and the question of when that translates into sustainable earnings is no longer theoretical. Why it matters. Asia's AI startups, many of which raised our roadmaps and TAM slides, now face a funding environment where investors want unit economics and paying customers before writing the next check. That shift hits hardest in Southeast Asia and India, where later-stage rounds were already thinning and bridge financing had become the norm. Hiring across the region's tech sector will slow as companies conserve runway, with generalist AI roles feeling the squeeze first, while applied engineering and sales positions hold up better. Capital allocators should watch secondary market pricing on Asian AI venture portfolios over the next 2 quarters, because the gap between marked valuations and what buyers will actually pay is the clearest signal of how deep this repricing goes. Now, Intel reported quarterly revenue of $16.13 billion, powered by a 59% surge in data center sales to $6.3 billion, reopening the question of whether a Western foundry can credibly challenge Asia's lock on advanced chip manufacturing. The company's foundry division narrowed its losses and named Fortinet as its first external customer, though the unit still trails TSMC by a wide margin in both technology node and volume. The results mark Intel's strongest data center quarter in 2 years and arrive as governments across Asia-Pacific double down on semiconductor self-sufficiency strategies built around the assumption that cutting-edge fabrication stays in the region. Why it matters. Asian chip policy, from Japan's rapidest subsidies to South Korea's tax breaks for Samsung and SK Hynix, is premised on the idea that no Western fab can match TSMC at scale. A recovering Intel foundry, even a distant second, gives Washington a credible reshoring card that changes the leverage calculus in every bilateral chip negotiation across the region. Capital allocators watching TSMC's premium valuation should track whether Intel's external customer pipeline grows beyond Fortinet, because each new design win chips away at the concentration thesis that underpins Asia foundry investment. Builders relying on TSMC allocation may eventually gain a second source, but the mirror effect is political. Expect Asian governments to accelerate subsidy timelines to lock in domestic capacity before Intel's foundry narrative firms up. That is your AI in Asia briefing for today. Stay sharp, build well, see you tomorrow.